Well, good afternoon and welcome to an FS Club webinar on accounting standards and discount rates in defined benefit pension scheme evaluation, the contractual accrual rate. I'll be frank and say that this was not a heavily attended or registered event, but that doesn't make it unimportant. In fact, it is absolutely crucially important. And we are delighted to have here today Dr. Con Keating, Chairman of the Bond Commission of the European Federation of Financial Analyst Societies, to talk us through some of the issues involved in this and why it is so important and we should be paying more attention to it. Now, Con's a bit of a regular at FS Club. He's done 11 events with us over the years, and we're delighted to have him back because every time he's on, we all learn something, myself very much included, and he sends us away thinking hard about what we should be doing in dealing with the long term, which is, of course, is very much part of our long finance movement, of which Con is on the kitchen cabinet. Now, you know me, I'm Michael Mainelli, and I can only do all of these webinars with you and the other chairman because of the generosity of our FS Club sponsors who allow us to range widely and freely across all sorts of areas to do with technology, economics, and finance. Now, at one of our webinars last year, we had a friend of mine, Jim Briding, talking about what makes nations succeed in the long term. And he pointed out that they need to get four things right. Leaving defense to one side, it was very much the environment, it was education, it was healthcare. But the fourth, and just as important as the other three, was preparing for old age and ensuring that they were taking care of their populations as they went through life. So today's event is, of course, important to all of us who wish to live to old age, and even those who are in old age. And I would like to express my appreciation for Con sharing his thoughts. Now, my job is to get out of the way as quickly as possible, which I'll do so in just a moment after I make three quick points. One, yes, these slides are available, and we will be putting in the chat room several reports. Con has done some 20 pieces for pamphleteers and about another 10 detailed reports on issues related to what he's going to be talking about today that you can get into. Secondly, yes, this is being recorded, and the recording will be up in approximately 2 working days. That is Friday afternoon sometime. And finally, questions and answers. I would encourage you to participate in the discussion. There will be a real opportunity to ask Con given the small size of the audience today. So do think of questions to put in. Please do put them into the GoToWebinar question and answer facility so that I can feed them in, because I'm here with you, not on Signal or WhatsApp or what have you. I will also point out that all of the questions and comments will be sent to Con with your email attached. So if you want to contact him about something or want further points of detail, just type it in. And even if we don't get time for it today, it will come up to Con. So Con, I think with no more ado, if I can, and get you an extra minute or two, the floor is yours.
Thank you, Michael. Yeah, I would certainly agree about the importance of old age, given that I'm now 74, and it's long past time I gave up. Now, can we go to the first slide, please? Right. The point I want to make here is a very basic one about the way in which accounting standards are chosen and operate. The choice is of an interest rate to be used as a discount rate. In the international accounting standards, it's the AA corporate bond. The point is that that's a market rate, and it's actually independent of the history of the pensions that are being valued. It removes something which is terribly important. History matters. It's path dependency, but pensions accounting methods discount it. They just throw it away. And I'll give you a simple illustration of what is meant by this. Think about a 10-year corporate bond, 10-year zero coupon corporate bond, issued 5 years ago, 10% yield. Then you'll see immediately that that bond and should accrue, and we'll call these secured bonds. So the level of security you expect to have at any point in time over the life of that bond is shown by the blue line in the diagram below. Now, let's go 5 years in and we issue a new bond. It happens that market rates are 5%. So pensions accounting would have us discount both the new 5% bond and that old 10% bond at 5%. And you can see there would be then no price difference between the two bonds. Now, you see from that little red ellipse that's shown there that there's a significant difference in the collateral supporting those bonds. Now, reflecting its lower collateral, that 10-year bond would in a market actually trade at about 550. If we require, as we do with pensions accounting standards, the same level of collateral, the same level of funding for the 10-year as the 5, then that would actually increase the cost of that 10-year bond to its issuer from 10% to 11.2%. It's seriously damaging. That's the nature of the problem with pension accounting standards as we have them. Can we go to the next slide? So let's deal with an absolute basic. What is a discount rate? A discount rate is a measure. It's a tape measure, although it actually operates in the time dimension, but it just serves to reduce a number of different payments, future times which vary, to a common basis today. Now, the crucial thing about any measure is you want it to be invariant. An elastic tape measure to measure your waist size would be pretty much useless. Now, unfortunately, the accounting standards using market prices or market yields are emphatically not invariant. Okay, that leads to all sorts of problems going forward. Now, the second thing to understand about discount rates is that they are purpose specific. The discount rate you want to use for measuring the accrued obligations of an employer differ from those rates appropriate for estimating the replacement cost of those liabilities in a market. What I'm saying is that the cost or the value of the liabilities to an employer is different from the replacement cost in a marketplace. In the various accounting standards, discount rates come up in lots of places, and Iain Clacher, Mark Freeman and Alain Duplessis and I have written a very long paper for the FREG and the Scottish Accountants ICAS on which looks at different discount methods across different standards. They are all over the place. There is no intellectual consistency in them at all. And frankly, many of them are just simply not fit for purpose. There is one standard which is worth mentioning because it is, as near as any of them come, correct. And that is IFRS 16 for long-term leases. This is an endogenous discount rate. It's intrinsic to the contract that you are looking at. That standard specifies that for long-term leases, you discount the lease payments at the interest rate which was implicit in the lease. Okay, and that interest rate is invariant. It only in fact changes if the change is warranted by experience of some sort, such as change in lease payments. Can we go to the next slide? Right, now this is the contractual accrual rate, is a method that Iain Clacher and I came up with, which is we have simply just identified what the correct rate for discounting pension liabilities is. And it's the rate of return that the company implicitly promised to pay on the contributions in order to discharge the liabilities in full and on time. It's the rate at which contributions and assets should accrue over time. The rate is intrinsically unique, it's invariant, it's time consistent. Changes to that rate will only arise because of explicit differences in the true benefits ultimately payable. For the scheme overall, the contractual accrual rate is the weighted average of the awards made over time and across members. We call it the CAR, the contractual accrual rate. It's really important to understand that the value of a liability within a pension scheme is independent of the way in which that liability is financed. The liability is what it is, and how you finance it is a separate question. They are independent of one another. So let's go to the next slide. Now, I'm just going to illustrate the CAR for you. And the top diagram shows the cash flows of a 10-year deferred, 5-year fixed annuity of £100 per annum. And we set the premium arbitrarily at £180. The CAR then is the rate which equalizes those cash flows. It happens to be 8.23% per annum. The result then is you expect that deferred annuities liability value or liability trajectory to follow the red path shown. Now, let's introduce an asset to offset this liability. We want an asset which will pay us this. And we'll choose arbitrarily again an asset offering 10% per annum. Discounting at that rate will give you a present value of £146. So an apparent profit of around £34 relative to the £180 premium. But that profit is not earned. It's an embedded value. And that leads to all sorts of problems. In particular, it leads to a huge problem for insurance companies and for bulk annuities, because they will claim that differential as a matching adjustment and use that to capitalize their annuity books. It's wrong. The next slide, which I'd like to bring up, please. This shows you the evolution of embedded value and the realization of true profit. The blue line there is the embedded value. That's the difference between the liability trajectory and the asset trajectory we showed on the previous slide. Then we have the accumulated profit over the life of that contract and the amount which has been earned in each year, shown as the red bars. So there we are on that front. That's the simplest description of the contractual accrual rate and one thing that it can be used to show you clearly immediately. Next slide, please. Now, the regulatory standard is a bit different from the accounting standard. The regulatory standard requires discount rates to be prudent. Okay, it also requires the benefits estimates to be prudent. I have no problem with adopting prudent values for the projected benefits, but I do have a problem with biasing a discount rate for prudence. The principal problem of adding prudence to a discount rate is that it does nothing for the ultimate benefits. all it does is alter the path by which we get to those ultimate benefits. Now, given that we have ultimate benefits occurring over lots of periods of time, if you actually have a benefit payment occurring prior to the end, which actually needed some additional support, which was higher than had been projected, you are not taking that allowance from that particular valuation. Your value is being deducted from the prudence associated with other members, those who are still there and for whom that prudence in the discount rate is being applied. It's a quite subtle form of intergenerational unfairness, and it could be material in extreme. Again, I'd like to emphasize that the value of a liability is independent of its financing. So let's not get too carried away with that. Let's go to the next slide. This is really rather important to realize. Until we had arguably 1995, but certainly 2004 Pensions Acts, DB pensions in this country were fundamentally best efforts propositions. The nature of the regulation has changed this. Prior to 1995 and 2004, the fund really was the source of finance to pay pensions. It's changed. The fund now is collateral security for the value miscalculated according to the accounting standard, and a method of reducing the cost to the employer. That raises some questions as to why we now have pension fund asset allocations being driven by trustees for the benefit of members. It does though clarify one point, which is that if the assets are serving a role as collateral, the correct way of valuing those is using current market prices, not some discounted cash flow type method, which was used historically in the pensions world. The one thing, of course, about this is this value may or may not be sufficient to buy out the liabilities in the marketplace. The liability of the employer really is unrelated to the market price of bulk annuitization of a pension scheme. The idea that we should have schemes funded at a level where they can buy themselves out at any point in time is just pure insanity. It's an invention of the regulator, and it has no support in regulation. Okay, let's go to the next slide. For CDC, now CDC valuations are going to be interesting because it's going to be trivial to bring into effect the use of the contractual accrual rate. CDC schemes are required or will be required to produce an annual viability statement. This is a forward-looking process. It's going to use central estimates of all parameters, which is important and correct. There's no bias for prudence. Its discount rate, given that it's looking forward, should be an expected return on the assets held. That's appropriate because it fits purpose. Now, the question then is this fit for scheme management purposes? And my argument would be No, it's incomplete. What we need to know is not as much are the current assets, given a particular expected return on those assets, likely to meet the promises made, but have we actually achieved to date that which was originally promised? And that's what will be given to you by the contractual accrual rate. Now, I would argue that have we achieved what we promised is full performance, full execution of a contract, and is dominant over are we likely to achieve the results promised. I don't believe that anyone could take action against the trustees if they have performed as was originally suggested and promised. That is a very major point, and will prove, I think, a very major point, given that the pensions regulator and now has all sorts of new criminal and other powers with respect to actions which may or may not do damage to the pension scheme. So that's CDC. I'm going to be writing a series of responses to questions on CDC pension schemes and some others, and any questions which go unanswered from this webinar in the course of the next week or two. Let's go to the next slide. Right, does it matter? And this is the subject of our most recent paper, which will be available from the website here. And it's the paper which we have written to submit to the UK Endorsement Board, which is charged with responsibility for the adoption of international accounting standards in the UK after Brexit. Prior to this, it was all, of course, European Union. It's now a specific piece of legislation, the details of which are in the attached or the associated paper. That body is charged with, or the Secretary of State is charged with a number of requirements on the adoption of the International Accounting Standard, and standards, all of them in fact. One of which is that it has to be conducive to the long-term public good. It also has to do no harm to UK capital markets. So let's look at what's happened with the accounting standards that we have. Over the last 20 years, employers have paid over 200 billion in deficit repair contributions. That's a revenue loss of over 40 billion pounds of taxes. Ordinary contributions between 1999 and now have increased fivefold. Pension liabilities may have increased. I mean, pension liabilities in terms of the benefits ultimately payable may have increased by 100%. They have not increased by anything like their costs. Companies have reported in CBI surveys and elsewhere lower capital investment, lower wage payments, lower investment in jobs and skills, all because they have 200 billion less of capital to invest. Scheme closure has been rampant, and just 11% of private sector DB schemes which are open to new members. Now, one of the things which I don't think anybody bothered to explain to most groups of trustees, when you close a scheme to new members, you raise the cost of providing the pensions for the rump. People are getting older, the investment periods are getting shorter, and therefore the costs of providing go up. Pension asset allocations have moved from, oh, there's a typo here. Okay, there are two typos here. They've moved from 73% equity, not 75, to just under 10. And of that 10, just 2.9% is UK equity. That's a £1 trillion shift in asset allocation from equity to debt-like instruments. The London stock market has been the dog of world stock markets over the past 20 years. Back in 1999, it was over 8% of the world's total capitalization. It is now under 3%. I'm most amused by all of these people in Glasgow talking about the London stock market and requirements on companies to list here, as if the UK was still a really important equity market. It's not true anymore. And if you add a whole raft of new ESG criteria, you are most unlikely to see it recover to anything like its previous prominence. The LSE, I think, is problematic. Less than, from 7,500 plus companies in the late 90s, we're down to under, sorry, 7,500 was actually in the late 80s. We're now down to less than 2,000 companies listed on London. Pension funds own less than 3% of the market. Okay? Private equity is rampant, and there are all sorts of questions to be asked about private equity. Part of which is, the take private from public is partly a response to the fact that market valuations have been at best lackluster. The bonds have done exactly what you would have, well, bonds have done exactly what we expected. I mean, now we have 80% of index-linked gilts, over 80% of index-linked gilts owned by pension schemes. The result is that index-linked gilts are insanely expensive. The long-term real equity returns have fallen. They're down from around 6% historically to around 10%, to around 2% now. The harm that these accounting standards have done is evident in so many different dimensions. I could go on for hours about this. It's interesting because Aon produced a pamphlet, a survey of pension funds yesterday, and it showed that around 35% or so of pension schemes are more than 100% hedged on interest rate exposure and inflation exposure. That's just crazy. It's particularly so in the case of the interest rate exposure, because the interest rate exposure is not real. The interest rate they are hedging is the discount rate. That's a measure, and it should not be variant. So we are going to be sending the most recent report to the UK Endorsement Board, asking them to reconsider the use of IAS 19 and by implication also FRS 102. That brings me to the end of my slides, I think, Michael.
Well, Con, that's fantastic and perfectly on time. We've got quite a few questions and comments, so I'd like to start off. Now, your conclusion was that the case for revision of accounting standards and regulations is overwhelming. I'm not 100% sure that I personally wouldn't like an elastic tape to measure my waist, but you'd like to get this tightened up, and I can see that. Could you just go through quickly, for those in the audience who aren't familiar with the regulatory regime, who needs to be convinced to make this change happen?
Well, the regulatory regime is actually written into UK legislation. It's the 2004 and 2005 Pension Schemes Acts. Forgive me if I don't actually quote them in full, but it is actually the Pension Scheme Act 2004, and it's the regulations in 2005. They specify that you either use a gilt rate or a rate which is best described as the expected return on assets. If you want to change those, then it's necessary to do it by changing the Act itself.
So it requires primary legislation then, is that correct?
Does it? Yes, it probably does.
Okay. Derek Scott is curious.
It does. It's not a statutory instrument.
Okay. Derek Scott, in your research contacts with the accounting standard setters, do you detect any appetite for revision at this time?
No. In fact, what we have there, Iain Clacher, Alain Duboisier, Mark Freeman and I have spent more years than I care to think about working on a paper for EFRAG and ICAS. It has been the project out of hell. I think we are now in version 18 or 19 of that paper. I would say that the appetite for change is zero. I think that there was one man a very long time ago by the name of Brian Souter, who was responsible for Stagecoach, among other things, but who headed the Scottish accountants. He initiated the project to review the accounting standards because in particular, he was responsible for a pension scheme. He was aware of just how harmful the accounting standard was being, and he wanted a good academic analysis of what was going on. My read on what's going on since then, his presidency passed. We saw a change of personnel within ICAS. We saw the introduction of EFRAG to the sponsor group. And my read is, well, I mean, at one point we were actually told you can't criticize the IASB, to which my answer is bollocks.
Oh, okay. We'll return to this in a minute, but Hugh Purser's curious, could you give a simple example of just how radically different the investment strategy, the asset distribution, would be using CAR? Yeah,
it would look very much like the way it looked back in the late 80s and early 90s. So it would be very equity heavy. Probably not as much listed equity now. I mean, we had 75% or 80% equity allocations, 10% property allocations back then. Today, we have a greater menu to choose from in terms of assets and forms of investment, because we have seen some development of some hedge funds, which makes sense. We've seen private equity. There are a range of investments which weren't available back then. But the bond element would be quite low and would probably consist of bonds which are prone to mispricing and have elements of equity within them, such as corporate bonds, credit. I mean, credit is actually it's an equity option. So what would it look like? 80% equity, 10% property. The property class that I think will grow in terms of where we are now and where we're likely to go is residential real estate. And I think that'll be buy to rent and shared appreciation, rent to buy type structures, the sort of thing Wayhome's been doing.
Okay. Got a couple of, I'm going to wrap up 3 here because I think they're all related to risk. Henry Tapper is curious, what do you make of comments from our current pensions minister that DB schemes should be encouraged to re-risk? Jalil Bouzidi Thanks you for the presentation. What do you think about taking into account climate risk in discounting? This could reduce the value of stranded assets, increase the value of low carbon assets. And finally, Derek Scott, how do you allow for uncertainties like future revaluation of RPI, CPI, or CPIH, and longevity and mortality uncertainties when the obligation crystallizes?
Well, okay, let's deal first with the last of those questions, Derek's question. We deal with uncertainties in future variables all over the place. There are standard techniques for doing so. We use the best estimate and we use various other measures of the distributions of those. So what we have is a range of outcomes. We may have a central forecast, as is required now under the CDC legislation, but one can allow for the other variations and make provision against them. But what you are not doing is making provision in the discount rate. If you like, if you have, at the time you make a pension award, you have a range of possible values for the benefits ultimately payable, the projected benefits, then that gives you a range of acceptable discount rates, the discount rates which apply for very high outcomes for inflation, longevity, and so on, and for very low. And you can see what the range of uncertainty is. It's just applying the different discount, the different contractual accrual rate associated with the different liability estimates. But it's the liability estimates that drive these things.
Okay.
It's not a question of prudence in the discount rate. The discount rate is what it is, given the contribution was made. Okay. Can you repeat the earlier two now, Michael?
Yeah, the middle one was from Jalil. What do you think about taking into account climate risk in discounting?
No. If you want to take climate risk into account, you actually have to take that into account in other areas in your longevity, inflation, and so on effects. You don't do it in the discount rate.
Okay. And then the first one was Henry Tapper. What do you make of comments from our current pensions minister that defined benefit schemes should be encouraged to re-risk? And I'll tack on to that from Bob McDowell. Cynically, to what extent are financial regulators trying to protect themselves in terms of their discount requirements rather than good or prudent practice?
Okay. Both of those meet the same answer. Guy Opperman, the pensions minister, yes, he wants us to re-risk. The pensions regulator has just produced a DB code, which actually would have us go to sustainable buyout type levels of funding. That's to have an all bond cash matched portfolio. There's a disconnect between the two. The regulators are covering their own arse and have been doing so and have been salami slicing the DB world forever. Ever since we saw the Pensions Act and the creation of the pensions regulator. No one in their right mind is going to re-risk a DB pension fund in the current environment. If they were to do that, they could probably be criminally prosecuted by the pensions regulator. So maybe, Mr. Opperman, you might like to rein the pensions regulator in and change the regulation, and then we can think about doing that. But again, having seen all of this develop over 20 years, no corporate treasurer, no finance director in his right mind is going to open a DB scheme today. Yeah. I mean, those who want to do well for their employees will almost certainly open contractual collective defined contribution schemes. I think they are the future of wages or incomes in retirement.
Well,
It's certainly not DC.
that's a good sales point, folks. There are other webinars with Con and publications on CDC, but just sticking to this, Derek Scott comes back with, where DB trustees have a dual role in reducing employer costs, but also offering collateral security for the members, their legal duty seems to be to put members' interests first. So if correct, this does justify the stance of the pensions regulator. Then we've got another point here from Yin Kong. Is the value of a pension liability independent of its funding in the United States or anywhere else? In other words, can you give us an example internationally of something? And just a comment here from Donald McCrae about a real example for 2021, 2020 and 2021. Use of FRS 102 turned a reasonable overall surplus into a substantial loss. The actuarial calculated surplus on the balance sheet turned into an accounting deficit using FRS 102. So how can we achieve a change in these accounting standards?
Well, in terms of achieving changes to the accounting standards, I think it's a question of their adoption, and that's through the UK Endorsement Board. Now go back to the other questions, Michael.
Yeah. So the first one was Derek was asking really if members are first, then this is justify the stance of the pensions regulator.
Yes, the trustee does have a split responsibility, but his responsibility to the members is not to attempt to apply for greater security than that which is due. And that which is due is the employer's actual liability, the performance which was expected to date. The trustee could not demand on behalf of members more than that. That's what would be supported in a court of law. Okay, and that's the contractual accrual valuation. Okay, so yes, they are conflicted, but there's a limit to that extension, to the extent of that. The trustees can demand funding of the company up to the level of full funding as determined under the contractual accrual rate, but they can't press for more than that. The regulator, by comparison, is pressing for far, far more than that.
Okay. And was there anywhere internationally that's got this right?
Is there anywhere internationally? No, it's very interesting that we have the answer is not really, but the general point of a liability being independent of its financing is just an absolute truth. It doesn't matter that that it's whether or not it's actually being applied in anywhere. What is interesting is that in this country, the response to quantitative easing and the Bank of England driving yields down and liquidity up to insane levels was that pension schemes went out and bought tons and tons more bonds. So, they profit alongside the Bank of England in driving down the yields on bonds and making capital gains of a sort. The objective, of course, or one of the objectives of the Bank of England in driving rates down was to encourage them to do the opposite, to buy equity. Now, what is interesting is that in the US, where the accounting standard is somewhat different, the response from pension funds to the Fed's quantitative easing program was to go out and buy more equity, not bonds. So there we are.
Bob Compton oddly makes a related point. He contends that government has previously had a vested interest in keeping the status quo as it has helped reduce gilt yields. Now with the new government wishing to encourage investment in infrastructure, surely this would be a good time to start the process of changing legislation.
Certainly it has had the effect of lowering gilt yields. with pension schemes owning over 80% of linkers, the only way you can rationalize linkers being at 250 and 300 basis points through inflation, as they were at one point in time, is because of the sheer volume of buying that took place from DB pensions. Was it an explicit policy? No, I don't believe it was an explicit policy. Did it help with funding costs? In the main gilt market, the effect would be very marginal. There is a study which was done for the Bank of England by Zinner. The conclusion there was that it was insurance company buying of gilts that was about twice as important as pension scheme buying of gilts, of conventional gilts. That was done in I think 2013, 2014, somewhere around there.
Well, Con, I'm detecting a violent agreement with you from many members of the audience in the questions and comments that have been sent through to me, which you will get a copy of all of them with their emails if you want to get back. It's been a really compelling session, sharp and to the point on a big and important issue. Folks, as ever, sadly, when I see all of these thanks, it means it's time for me to wrap up. And if I can, 3 quick rounds of thanks. Firstly, to all of you, thank you very much for your questions, comments, and observations on a technical subject. I'm sorry if I didn't get around to quite everyone, but they will get to Con. Secondly, thanks to our sponsors for allowing us to tackle some of these deeper issues in finance, and an issue that I think we would all agree is important. But I would, of course, also in particular like to thank you, Con. One day it's going to turn out that my technology will be up to scratch, but I'm unfortunately able only to thank you using my Korean karmic clapper. But we hope to have you back, and I hope that all of the folks here will check out the forthcoming events, not least those of you who are greedy can see next Tuesday, where have all the 300,000 pound jobs gone, which I think should be an interesting one. I'm curious where they are, so get out your, dust off your CV for Tuesday. But Con, my Korean karmic clapper looms. I do hope the technology catches up for proper applause soon, but for now, thank you very much. And we hope to see you back as ever. You're one of our regulars and we love you.